Welcome everybody to yet another Take Back Control Tuesday. And I want to thank you all for joining us. Now, I can't tell you what the outcome is going to be for each of you, but what I can tell you is what you're about to learn absolutely can change your financial future. If you're here, you're probably ready for change. And what you're going to learn and the insights you're going to take out of this will help you get there. So if the prospect of taking back control of your money isn't enough to keep you glued to this screen right here for the next 90 minutes, then I think we really need to reassess our priorities. And tonight we have an extra special guest, Mr. Carson Herling. And you know, there's an interesting story. I met Carson through his dad. His dad's been a dear friend of mine, and his father was the first person I ever heard on stage say this. He said, the ultimate in real estate is being the bank. And now the legacy passes on, and you're gonna hear from Carson. You're gonna hear about how this has changed his life, but not just his life, his young family's life. So let me just give you a quick overview of what you're gonna learn. There's essentially three basic things you're gonna learn from tonight. Number one, you're gonna learn how to take back control of your money by being the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses, and it's not gonna require you working harder, working longer, or taking on any additional risks. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. If that's not enough to keep you here, well then, you're riding a bicycle home. All right, so that's enough from me. Let's dive in.
Take back control.
Tuesday. Tuesday?
Hello, everybody. We're excited for you all to be here today. Thank you for spending your Tuesday afternoon with us to talk about your guys' favorite topic, how you can become your own bank. We're here to talk today about how you can become your own bank. How many of you guys in the chat, this is your first time hearing this presentation, just so I get a feel of where we're at? If there's nobody that's new, then let's dive into some deeper stuff today. Let's see. Anybody in the chat? This is your first time learning about this strategy, okay? All right, a couple of you guys. All right, let me change up the presentation real quick. I'm gonna stop sharing and add a couple different slides. Excited for you guys to be here today. Thanks for spending your Tuesday with us. Where are you guys calling in from? You guys at work? You guys on your lunch break? You guys at home? A lot of spring break people going on right now. I'm hearing people who are teachers and in that world are off, or maybe you have your kids with you today too. What we're gonna talk about today is none other than the concept of infinite banking. It's a 200-year-old strategy, been used by the wealthiest families across history to use their money more efficiently, to eliminate debts, to minimize their taxation, and to prepare long-term for their financial needs. And it's something that I love talking about. It's something that I spend most of my time talking about. And I think today I'd like to hit high level stuff, what this is, but we can dive a little deeper. And I encourage you guys to ask questions. So because it is a group of a lot of people we know today, some newbies, I'd love for you during this presentation to throw your questions in the chat, because when questions pop up, maybe we'll get to it at the end, but let's hit them while we go and maybe go deeper onto each of these slides. So I always start with where this strategy started. I didn't start this. Chris Naugle, who you guys probably saw in the ads and other YouTube videos, did not start this. This strategy was set up by a man named Nelson Nash, and he studied this strategy because he saw other people doing it. People that you all know of. People like the Rothschilds. You all know the Rothschilds. I'm sure you've heard that name before. People like the Rockefellers. You all know the Rockefellers. People like Ray Kroc. And what business did Ray Kroc start, guys? You guys all know what business they started. Some think it's McDonald's, but in all reality, he started a real estate company and a franchise that he could build off of, different business model. And then we all know Mr. Walt Disney. I'm actually gonna go to Disneyland tonight, guys. I live pretty close by. And so I'll give a little shout out to Mr. Walt for what he did, but he built his company when he was dead broke in the Great Depression through this strategy. And those of you who are football fans, we all know Mr. Jim Harbaugh did this as well when he got his last contract with Michigan about 2016. He had this incorporated into his contract to ensure not himself, but his whole family to build wealth forever. And for myself, I learned this strategy from Chris Naugle and some other mentors. And it changed the way I use my money and how I purchased things, how I invested. And over the past 3 years now, I've been able to meet with over 3,000 families across the country teaching this strategy. These are some photos of my wife and I, Anna. We live in Southern California. And over the past 3 years, as we've been teaching this, utilizing it ourselves, has allowed us to buy real estate more effectively and build a perfect foundation to build not just kind of a rich lifestyle, but generational wealth. And my story is pretty simple. I'm sure actually a lot of you guys have heard it or you relate with it because I made a lot of mistakes, as all young people do. And I did one thing right, though. I actually went and served a church mission where I lived abroad in the country of Georgia for a year, teaching people about Jesus Christ. And it was an amazing experience. And I still hold true to that faith. But when I came home, I had a lot of outside influences pushing me different directions. I had mentors in my life teaching me about real estate and entrepreneurship and business ownership. And there was that world I was a part of. But I also was in the traditional path. I was in school. I was learning about economics, math, English. And this route was really grooming me to be an employee in the corporate world. And I had to make a decision of which route do I really want to go down, because they weren't going together. They were going farther and farther apart. In my mind, there was more and more tension within my life. And I didn't want to be a part of the so-called rat race. And so I made that decision to drop out of school and actually pursue an education in investing and learning how to make money work for me. And that changed the course of my life to the point where I could be here today. But above all, what's I think most important to me is family. And I assume you guys have similar standards and morals and goals for your guys' lives and families. And so I assume you guys are here today to talk about how you guys can be more efficient with your money so you can spend as much time with your family as you want. Is that right? Give me a thumbs up or a heck yeah in the chat. We're here to make more money, to have more time, right? So what I really want to dive into today is something that I learned as I was going through my financial journey. And this, yeah, I like it, guys. Yes, for sure. So what I questioned was the financial system. Why were we taught to do things the way we were? Why wasn't it working for some people and it was working for others? And so this question kept coming up. This question of, could it be possible that there are more efficient environments to store wealth outside of commercial banks that we're not aware of? Now think about that, guys. If this is your first time, genuinely stop. Think. Where are we taught to put our money? The commercial banks and the traditional financial path. Is that the most efficient way for us to use our money? Is that the most efficient environment we can store our money? You guys know? Well, for me, this is a powerful question because this kind of gets you thinking about what you haven't yet been taught about. And so I hope when it comes to money, you guys can have a humble and kind of a learner mentality throughout your life. And I'm sure you guys all have read books like Rich Dad, Poor Dad or Money Master the Game, or Richest Man in Babylon, all these different money books. And what do they all teach? Every single one of them teaches save money. You'll never build wealth without saving money. And they always say save at least, maybe 10% of your income, 1/10 of your income put aside. Even the Bible states that. I hope most of you guys are doing that or trying to do that. But in today's economy, it's difficult. Most Americans don't save that. Most Americans save 2, 3, 4% of their income. It's not enough. It's not ever going to be enough. You're never going to build wealth. You're going to be stuck in the same rat race forever if that's you. In our American culture, the problem is we don't value saving. We don't. We really don't. We don't value the control of our money. Evidence of that is the second you get a paycheck, what happens? They pull some out of your account to put it into a 401k. They pull some out to put it into a tax payment. They pull some out to pay Medicare, Social Security. You only get a portion of your money right off the bat. And then whatever you're left with, you pay it to the banks for your mortgage, for your car note, groceries, bills. You're not left with anything. You pay everybody but yourself. And so the reason I don't think Americans actually value saving is because the environments or the places that we're told to store this wealth is not efficient. Places like savings accounts, high yield savings accounts, money market accounts, 401ks, these places are so inefficient that it's hard. It's hard to save money because once it's in those places, you feel like it's not doing anything. It's hard to see growth. And so what I want to talk about today is not just that environment that's more efficient to store your money, but then how you use your money. And I look at it as banking. Banking is what you're actually doing. And the banking, if you look up banking, the noun version of banking, it says it's the business of protecting money. So it's a business of protecting money. So why are you banking with other people? Why are you doing that with other organizations? And if you look at the verb form, the actual act of banking, it's protecting money, it's depositing money, and it's lending money. So the interesting thing is that we do all of these things with other people. So how would that affect your life and your financial future if you were the bank? If you were protecting your money, you were depositing it somewhere you controlled and you were earning interest, and then you lent it from yourself. That would mean you're in control of everything. And so throughout this presentation, I want you guys to start thinking about banking with this definition in mind and how we can do this through somewhere we could control. And I told you guys we're going to talk about how you can become your own bank, right? So what is the bank that you set up? What is the bank that you use to do banking? And I want to compare your bank to a traditional bank, a savings vehicle. I want to show you the differences between these two types of money, or these two types of environments to store your wealth, I should better say. So they're liquid. You need your bank to be liquid. If it's not liquid, you can't do anything. Traditional banks are liquid too. You put money in a savings account, it's just there. So, skipping forward. After that, you're earning interest. You would want your bank to grow, right? You'd want to earn 2, 3, 4, 5, 6%. And what if that interest in your bank was uninterrupted, meaning it was never going to be touched? It was going to compound forever on itself with no interruptions, and it was tax-free. Whereas traditional savings vehicles, the average account is saving and earning 0.07%, and it's taxed. So that would be nice, right? If you had a place to put money that did this, that would be cool. And what if it was protected? What if it was safe? If you were ever in a lawsuit, judgment, lien, bankruptcy, divorce in some states, what if it was safe? Anything in your bank is not. And what about protect or stability? In 2009, 364 banks went bankrupt. What if your bank did it? What if your bank actually was profitable and guaranteed interest and you earned and grew that year? That would have been helpful, right? That sounds like a foundation, right? That sounds like something you could control, you could count on, you could use to finance everything throughout your life with no hesitancy and all certainty. This would be something you could count on to then go finance all your activities throughout your life, to make all your investments. So what is this bank? What are we setting up and what are we using to do banking with? Well, I call it a vehicle. A vehicle because it's something your money runs through. It doesn't go in and sit and stay there forever, but it's running through the vehicle. And before I share with you what the vehicle is, I want to share with you a quote by Mr. Will Rogers, who says that the problem in America isn't so much what people don't know. It's what people think they know that just ain't so. So just because you've been taught a certain thing, and those of you who are on here for the 30th time, maybe, I know you've heard this quote many, many times, maybe change the way you look at it. What are other things in your life that you are just complacent to? What are you doing in other aspects of your life that you just think are normal and comfortable? It's maybe what you're not thinking about that you should be doing. You just haven't yet been taught. So what can you better educate yourself on to avoid that complacency? Those of you who are on here for the first time, guess what? The vehicle we use to do banking is none other than a dividend-paying whole life insurance policy from a mutual company. Good old life insurance. How many of you thought that's what we're going to talk about today? Maybe you haven't seen our ads and stuff. Life insurance is the most safe asset class in the world. It's the most profitable historically. And you as the policyholder are in complete control. It has all those benefits I told you 2 minutes ago. It's guaranteed. It's tax-free. It's going to grow for sure. It's protected. There's stability. And on top of that, there's a death benefit. And on top of that, if you want to access any of the money in your policy, you can whenever you want. And this is not just a regular whole life insurance policy. All these things I'm talking about, you can't do in a regular policy. You need a specially designed and engineered policy to do all these things I'm talking about. Hence why we do these presentations. We teach people this strategy, show them how to incorporate it, and know how to build a policy correctly for it. That's what we're here for. And so this policy, again, is not like policies you've seen before. I like to look at it almost like a Ford Focus, for example. You guys ever go to a car dealership and see a Ford Focus? You see a car looking like this in the driveway. It's a fine car. It's a normal car, whatever, right? You're not hyped about it, but it's great, right? It's fine. So you see this car here, and then maybe you're home. You're on YouTube. You're browsing and you see Mr. Ken Block going 150 miles an hour in a Ford Focus drifting, but it's this car. It's this car that he's using. It's the Ford Focus too. But what's the difference between that first and the second one? Design and engineering of the product, of the car. It's the same car, the same chassis, but a different structure. So that's how these whole life policies are. It's a different structure of a policy designed to be supercharged, designed to look more like a bank account, more like an investment than life insurance itself. And we can build a policy to have complete liquidity right away, which allows you then to control your money and still have access to it to go do what you need to do. And when I hear about whole life, when I hear about this from other people, when I learned about this, I thought, no, there's no way you can get life insurance where you have access to all your money right away. No, there's no way that you can have tax-free growth and compounding interest in life insurance. Life insurance is a payment. It's an expense for a death benefit. I'm 22. I don't need a death benefit. What are you talking about? That's what I thought. And then I also heard some people saying, it's got a low rate of return. It's expensive. I've even heard some people say it's the worst investment of all time. Well, if that's the case, then why were all those individuals that I mentioned at the beginning using this? And the reason they were using it, and the reason I use it, is because it's not an investment. That's the biggest thing I want you guys to understand, is whole life is not an investment. So when you guys go home and talk to your friends and your family, your spouse, your business partner about this presentation today, and you say, hey, I'm going to do this whole life thing. I'm going to use it to be my own bank. They're going to say, oh, well, no, you don't use whole life. Whole life's got a terrible rate of return. Well, then you're going to say, you now know, well, then you're going to think, you now know that person has no idea what they're talking about because they can't even correctly identify what type of asset that it is. It's not an investment. It has guaranteed growth. There's no risk. So how is that an investment? An investment requires risk and volatility. It's not that. It's just a different asset class that maybe we haven't taught how to use yet. So when I studied then this concept, I read this book by Mr. Nash, Becoming Your Own Banker. Fantastic book. Every single one of you on this call should buy this book right now. It's on Amazon for 20 bucks, maybe less. Those of you who have been around the campfire for a long time and haven't read this, go buy it now. And in this book, he talks about the problem that we have in America. The problem is, not in America, in the whole world. We finance everything in life. Everything. Whether you save up money and buy it cash, whether you get a loan from the bank, whether you take loans and leverage other assets, you're still financing it in some way. That's what he talks about. He says you either borrow money and you pay interest to other people, or you own your money, you use your money that you have, and you pay for it cash, but then you give up the interest that you could have earned. If you have a car for 30 grand you're going to buy, and you save up the 30 grand to buy it, and you're stoked that you don't have to pay interest on it, then you spend the 30 grand to buy the car, well, you just lost 30 grand still. You lost the ability, the interest, the opportunity cost of using that 30 grand for other things. And so you're financing all these things throughout your life with other banking organizations, not yourself. You're not in control of it. You're not the one compounding, making a spread like the banks are. But you can. And you can through a policy. And it's actually crazy that not everybody does this because banks do this. Why hasn't everybody taught this if those at the top are doing this? Banks, these 4 banks alone, have over $60 billion in whole life insurance. It's called BOLI. I'm not making this up. You guys can find that any bank report, they will show you how much cash value life insurance they have. And these banks don't have ULs. They don't have variable universal life. They don't have term. They have whole life. So why? Why is this what they do? And if you want to study what banks do and understand them further, let's talk about how they move the money around. If you had $100,000 and deposited into the bank, call it 4% they're paying you. You have a great bank, they're paying you 4%, and you're stoked, right? Let's call it that. This number can be whatever you want, 100,000, 10,000, 1,000. Same idea comes across. They immediately take that money and they go lend it out. They'll lend it to somebody on a car note at 7%. They're going to make a spread on you. And then what is the homeowner going to do when they close? They're going to pay the seller. And where's the seller going to put their money? Right back in the bank. And then the bank's going to lend it out to somebody else on a car note at 8%. Who's going to pay the car dealership? Who's going to put the money back? Who's probably going to lend it to somebody else at 9%. On a home remodel loan, who's going to pay the contractor? Who's going to put the money back in? And maybe one more debt thrown in there, a debt consolidation of 12%. Guys, look how the money's moving. Your money's working many, 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 many times for the bank while you're making a 4% spread or 4% interest. They're making a much larger spread on you. They're actually making 3% on you on the house, 8 on the car, 9 on the home remodel. They're making a 5% spread on that home remodel loan, and then 8% spread on this loan. So if you total all of those up, the bank's making 20%. They're making 20% more than you are every year. And 4 goes into 20 how many times, guys? 5, meaning they're going to make 500% on your money. 5% more than you are on your money each and every year of your life. So no wonder banks are filthy rich and they have every massive building in every downtown spot in the country, in the world. They know what they're doing. So why don't we just mimic what the banks do? And if the banks are buying whole life, the banks are leveraging it to make other investments. Why don't we? Banks actually make between 400 and 1,300% on the money that you leave there each and every single year. Think about that. It's absolutely insane. The last thing I want to share with you guys before we get into raw numbers is compound interest. This is a fun exercise because this is going to really blow your mind when it comes to money math, I like to call it. How many of you guys in the chat, time to wake you guys up, you get some comment in the chat, every single one of you, all 100 of you or however many are in here. Would you rather have a penny today that doubled every day for 30 days and then stopped, or $1 million right now? $1 million a day with a penny that doubled every day for 30 days, and you had it in 30 days. Frank with the 1 cent. Justin's thinking penny. Good move, Justin. You guys are right. A lot of you guys. I'll show you the math, though. Here's why the penny makes sense. A penny at day 1 is just a penny. Day 2, it's 2 cents. Day 3, it's 4 cents, then 8 cents. 16, 32, 64, $1.28, 2, 5, 10, 20, 40, 80, 163. And then on day 16, it's $300, $600, $1,300. By day 30, it gets all the way to 5.3 million. It's a lot more than $1 million, right, guys? That's impressive. I'll take a penny that doubles every day for 30 days. Who else, right? 5.3, that's pretty cool. Well, what if instead, what if while you were compounding, you had a 2% fee attached? So every year you doubled, but there's just a 2% fee. 2%, that's all. And a lot of you guys probably have money in market accounts or with brokerages or other companies. I bet you they charge you a 2% fee, maybe more, maybe less. You might not be thinking 2% is a lot, but if you do the math, it only ends up compounding to 2.9, the penny. So the penny went from 5.3 just to 2.9. You lose 2.3-ish million dollars of compounding, all because of a 2% fee. That's not 2%, that's a whole lot more, right? So that compounding effect of money against you is also pretty impactful. Well, what if it wasn't a fee? What if there was withdrawal? What if on the 15th day you took out $100, and the 25th day you took out $100 because you needed to finance something in your life or pay for something, right? Let's just say that's all you did, $200. If you withdrew just $200, you would have only ended up with $2 million. $200 just cost the penny over $3 million of compounding. What about taxes? Let's say there was a 15% tax the whole time you did it. 15% taxes would result in you only having $500,000 left over. Is that 15%? 5.3 million to 500 grand because of a little tax. I'm sure you guys are in a higher tax bracket than 15, maybe some of you. So it's going to be worse. And what's funny to me is the places that you're told to put money, you do all 3 of these things to it. There's going to be a tax. Whether you pay it now or later, there's going to be a tax in that account. You're going to withdraw from it because things come up, life happens, you're going to pull it out. And there's always fees. So you're putting money somewhere that has all 3 of these things going against you, and you expect to have compounding growth? No. You're never going to get compounding growth. It's a myth. It's not going to happen. And guess what has all of these things going for you? What environment, what vehicle, what place can you put your money that doesn't have taxes? You're never going to withdraw from it and stop the compounding. It's never going to get interrupted. And there's no fees. There's no 2% management fee like a brokerage account would have or a money manager. Life insurance. Whole life insurance will compound uninterrupted every single day of your life. Now, it's not going to double every day. That'd be pretty cool. But it's going to have a steady, simple rate of return the rest of your life. So this is why we use life insurance as a foundation. There's nothing going against it. It's completely safe and it's going to be guaranteed forever to grow, which means now you can use this as the certainty aspect of your financial life to go make the riskier moves. And then you can leverage your policy by taking loans against it. If you take a loan against it, it's not going to stop your money from compounding, and it's going to be tax-free. So you can take a loan against your policy and go buy your rental property, go start your business, go invest in your buddy's company. And now you still get to make those investments. You still have the growth there, and you also have the policy as the foundation. So thus far, we've talked about the power of life insurance, the credibility behind who's doing this, how you can do it too, and why it's being done, how banks do this and how they operate, and why you'd want to become the bank, and now uninterrupted compound interest and the importance of that. So how can we go use this now and put it into action? I'm going to show you guys next how you can buy a car and get all the money back for it. Every single dollar that you put into a car, you will be able to get back on every car purchase you make for the rest of your life. Now, this is going to be a powerful example, and I'm going to show you real raw numbers of how this actually works, how you deposit money in life insurance, how you take loans against it, how you compound in there, the whole idea. I'll give you an example right here. So I call it the bank, right? This is your policy. And here's a policy on the right side. Now, do not dive into these numbers yet. You're going to get super confused. Let me explain it to you. Give me 1 minute, though. I'll give you some breakdown. And I'm going to start with the premium. When you guys hear premium, you probably think, that's an expense, that's a bill, I hate expenses, I don't want another premium. And you're all wrong. That's not what premium is. If you look at car insurance premium or home insurance premium, that is what it is. But in this scenario, whatever you put into the policy is liquid. And who doesn't want to deposit more money in their savings account, right? So let's call it a deposit. It's not a premium or a payment. It's a deposit. You're storing money somewhere that you can control. So it's a deposit. And I'm sure some of you might be thinking, I'm too old to do this. I'm in my 40s, 50s, 60s, 70s. Some people came to me one time and said they were 40 years old. They were worried they couldn't do this anymore. Guys, age doesn't matter. You are extremely young in all those age groups. You can get life insurance just fine. Sure, the older you are, the smaller the death benefit. That is true to all life insurance. However, I'm not building this policy for a death benefit. Neither are you. You're building the policy for the banking abilities you have in it. So age doesn't matter. If you put 10 grand into a policy and you're my age or my dad's age or my grandpa's age, we all put 10 grand into it. It's all 10 grand. It's all the same growth we're going to have. It's all the same cash value. I'm going to have a bigger death benefit though, right? So there is that, but I'm building this policy for banking. So let's dive into this and show you how this works. This is an example of somebody who was saving 10 grand a year. That was $800 a month. They were saving, they were putting it in their 401k or their savings account, and they chose to stop that and put it into their policy instead. So that's what they did. 10 grand a year in premium. And they did it for the first 7 years. And over here on the right side, this is your cash value. This is what's available to access and take a loan out for and leverage to go use. So year one, he deposits 10 grand into it and had access to 6. So cool. He has $6,000 now he can work with, invest with, take out loans from, and go do his thing. Year two, it's 12. It stands for money multiplier, Justin. That's just our company name, but we'll call it the cash value in your life insurance. In year number 3, the cash value decreases to $4,000. The reason is because I want to show you taking a loan from your policy to buy a car. So he put in $10,000 a year, and after 3 years, he's put in 30, and he's taken out 25 to go buy a car. So he took a loan from himself for 25, went and bought the car cash that's sitting in his driveway. Now what is he going to do? Well, if he took a loan from himself, he should pay himself back like he'd pay anybody else, right? So a $25,000 loan, today's interest rates will call it $500 a month for 60 months, a 5-year car note, like they all are. That's $6,000 a year. So $6,000 a year he repaid to the policy. Look, he paid back $60K over 5 years. That's $30,000. So he put in $70K in premiums. He took out, or he also put in $30K as a loan repayment, and he took out 25. So he paid himself more than what he took out. He's being an honest banker with himself, and he's paying himself back with interest. So if he put in 100 over the 7 years, taken out 25, then you would say, well, his net input into this, his net injection is 75,000. And here's the cool thing. I told you guys you'd get all the money back for any car you ever drove or owned, right? So how? Well, during that 7-year period, the entire cash value was still earning interest, still earning dividends, still tax-free growth. You still had a death benefit. And because you paid yourself back and refilled your cash value, look at the cash value at the end of the 7 years. It's $67,881. If you've put in 75 and have access to 67, that means you got back 91% of what you put into it. You got your car 91% off, you could call it. But I told you you'd get back 100% of your money. And I'm going kind of slow through this because some of you haven't seen this before. This is probably a lot of numbers, might not make sense. I'm going to try and go slow. But I told you how to get back all the money, 100% of it, not just 90%. So let me show you how to do that. In the 8th year, he said, hey, I don't want to pay any more premiums. So he didn't. No more premiums from year 7 and on. That's not always how policies are designed, but sometimes it can be. He also said, hey, I want to buy a second car. I need to get a car for my child now. So $25,000 loan from his cash value again, went and bought a brand new car or whatever, used car for his kid, and then paid himself back $500 a month as if he was the bank financing it. Now, what does that look like? $0 in premiums, $30K in repayments, took out 25. So his net injection into this thing is $5,000. He put in $5K over the 5-year period. That's it, $5,000. And look at how much his policy grew over that time period. It went from 67 to 91. The cash value grew $23,000 in his policy, and he put in He put in $5,000 and got $23,000 of growth. So he made money off of buying the second car. So there's 3 rules we have when we talk about this. Rule number 1 is pay yourself first. Rule number 2 is pay yourself with interest. He paid himself first. He put 10 grand in every year instead of putting it in other places. He paid himself back with interest like he should. And he then recycled and recaptured that interest, because who wouldn't want to pay themselves interest versus somebody else? He recaptured that money instead of paying somebody else. So if this works for a car, what else does it work for, guys? Everything. It works for anything. You could pay for your taxes this way. You could buy your next rental property this way. You could go and start doing private money lending this way. You could pay off a debt this way. Pay for tuition. Start a business. Even contribute to a Roth IRA from the policy and get benefits of both worlds. How cool is that? So I'm going to show you a couple more quick examples before we wrap up and get into some Q&A. Question or example number 1 is paying off a debt. And this is kind of how the money moves. It's through this circle of money. It goes from your policy, the money multiplier policy, it's our company name. It's just a life insurance policy. And let's say you deposited $30,000 into it. And then you took a $23,000 loan from your policy to go pay off a line of credit. So you had a debt and a line of credit at 9% for $23,000. Instead of paying off the line of credit directly and getting rid of that, you put it through a policy first, and then you use your policy to pay off your debt. So that's what he did. Took out 23, paid off the line of credit, and now he no longer has to pay $289 a month for that line of credit. That's what the payments and the debts were. So if he no longer has to pay that payment because the debt's gone, what should he do with that extra money now that he has freed up? Pay himself back. Use that money to repay himself, refill it, pay himself instead of somebody else. So he does. He recaptured that payment every single month to refill his policy. And remember the benefits of doing this. While he's now recapturing the money and cycling it through a policy, his original amount he put into it is still earning interest, still earning dividends, and compounding with the insurance company. He still has a death benefit. He still has tax-free growth, right? All pretty cool. What if instead of paying off a debt, he went and did some lending opportunity in the private money club? Let's say he took the 23 out and lent it on private money club, and someone was paying him 12% a year of all income, extra income. He'd use that extra income and that cash flow to repay his policy, refill it up, and then go do it again. So now he can make money twice on all of his investments and have a death benefit while he does it. That's pretty cool, right?
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action, like so many others have, by going to privatemoneyclub.com and sign up.
And this is the slide I added. Actually, I think it's after this one. So only 1 of 2 things are going to happen to us. We're either going to live or we're going to die, right? So it's going to happen to everybody. So while we're alive, are we better off with this than without? Well, yeah, I'll show you how you can pay for your life, make investments, pay off debt much more efficiently. You can have a strong foundation to finance your lifestyle. What about if you die? Well, if you passed away, your family is now much, much better off. Because if you did all of these different things with a bank or yourself, you're giving them all the cash and you have nothing left over, or maybe whatever is sitting in your checking account at the time of graduation or passing. But because this is life insurance, your family's going to get a huge lump sum of money paid out to them tax-free. So your family's better off with this than without. So thus far, we've talked about how banks can profit by leveraging your money and how you can flip the script and become your own bank. Why you don't need to be rich to do this, because anybody can do this as long as they have the right tools. And with inflation and market uncertainty, family banking gives you the total control. If you guys want financial control and you want to be the bank, then you absolutely need to set up a banking policy as soon as possible. There's no ifs, ands, or buts about it. This is the place to finance your lifestyle from here on out. And our company does not charge anything for setting these policies up. We get paid from the insurance companies for the business. So we set these policies up, we'll coach you through using it, teach you how to be the bank, and you're off on your way. And you'll come back to us to have policies over time. And that's a way we can build our business. But that's because of the value that we provide and the guidance for you to do this and the value it's going to bring to your life. You're going to want to be adding more policies to build out your family system. So I want to end with my phone number, guys. This is my personal cell. If you guys want to have a deeper dive into this for your own personal situation, I'm not going to put my QR code or send you my calendar. I really want to meet with you guys personally and get to know you. This is my personal cell. Shoot me a text. Tell me your name, the webinar you came from, so I can make sure this is this webinar. I know what I presented to you. And then we can set up time to meet and talk about how you can implement this yourself. Those of you who are watching the recording, which I know this will go out afterwards, same thing applies to you guys. Feel free to shoot me a text, send me your name, or if this is the presentation you saw it on, and let's connect. If you guys just have a question, let's go through those now. If you guys are watching the replay and you have questions, shoot me those questions via text and I can get back to you with the voice message or something like that. If you want more resources, you want podcasts, books, YouTube videos to better learn this strategy, get more examples, text me that as well. I'll send you whatever you need, any kind of resources you want. Shoot me the text. If you want to just set up time to meet with me directly and you're ready to just talk about it, I'm throwing in the chat here my calendar link. If you'd like to set up time to meet later this week, I opened up some spots. So there's plenty of stuff available. I just threw that in the chat. If you want to book time to meet with me, there you go. Carson.beyourownbanker.com. That will send you directly to my calendar. If you wanted to just chat, have a phone call, get more resources, whatever you need, shoot me a text. We got about 15 minutes here to wrap up and go through Q&A. I saw you guys in the chat. We're crushing the questions. Anthony's already answered all of them for me because you're awesome, Anthony. Thank you. But there's tons of questions. So let's start going through these now. And yeah, if you have more questions, throw them in the chat. Let's get through all of them. Douglas messaged me at the beginning of the presentation and said, what is the trust, AKA the bank, and what trust facility is trustworthy? It's a tongue twister. And from what branch whole life policy is correct? I'm not sure if I understand your question or if you even understand what you're asking, man. Kind of an interesting question. But a policy is not a trust. If you're looking for a trust for your estate, a whole different product and situation. If you're looking for, you said a trust facility that's trustworthy. If you're looking for a trust, we have a company that we work with that sets up trust I can connect you with. If you want a whole life policy, different conversation. If you want the beneficiary of your whole life policy, so that when you pass away, the death benefit is going to go to that beneficiary. If you want that death benefit to go to a trust instead of a person, then you would need to set up that trust, and then you can add the trust onto your policy later on, and that's definitely doable. So if that's what you're looking for, Douglas, hope that answered your question. All right, let's get to the other chat here. Alex, no question. Alex asked, if you put money in a whole life policy, does it does it come out of your paycheck? And he said, well, he's comparing it to a taxes and 401k and all that. Because if you get a paycheck every 2 weeks, that paycheck gets deducted from those other expenses right off the bat. So no, whole life policy is not like that. It's not going to get taken out of your check. Your employer does not fund the policy for you. So you will get all that cash sent to your personal bank, and then you will use your own personal cash to fund your policy directly. Let's see. Can you manually pay back to your loan, Justin said, or do you have to manually do the paycheck back each month? So you can do it on a monthly basis automatically. You can repay your policy actually however you want. So you could repay it on a set monthly basis that's automatic. You could do a manual every few months. You have extra cash, you can repay it. Or if you wait till some big lump sum of money that comes in, you can use that to repay your loans. You can pay your loans back however you want. You are in complete control of your policy loans. The insurance company is never going to say, oh, you owe us a payment. Oh, here's your expense per month. Here's your amortized loan. Like, no, they could care less. They send you the money for the loan, and that is it. There's no credit checks. There's no paperwork. There's no approvals. They send you the money when you ask for it, and you pay it back whenever you want. So you're in complete control of the loan factor. And the reason the insurance companies do this is because they use your death benefit as the collateral. So if you were to pass away and you have a loan on your policy, they'll just pay out the death benefit minus your loans. They'll keep the loans so that they can repay themselves. So they know they're in complete control of that loan. They'll let you take out as much as you want, pay it back whenever you want. And yes, you owe interest on that loan. So you'll want to repay that loan, and you'll want to refill it back up to then go leverage it again. It's going to be, that loan kind of works like a HELOC if you have one. So that's how your loan operations will work. Justin said, you said you don't make money selling these policies? No, we do. We make money from the insurance companies. We get paid from them for the business that we're bringing them. And I think Anthony already answered you there. But yes, we're paid from insurance companies. So Douglas and Angie, I'm going to get to your question about the IUL in a second, just kind of a longer answer. So I'm going to get to some of the shorter ones first. What is the difference about what is banking? So what is different about banking out of a whole life policy? I might recommend you, Douglas, to rewatch the presentation. That's what the whole thing's about, is why banking through a policy is more efficient. The short answer is short answer is banking is protecting money. Banking is depositing money, lending money, and you're doing that with other people. Other people are making spreads on you. Other people are using your money to build wealth. You're not. So if you could bank in a whole life policy where you're the one earning interest, you're the one making the spreads, you're the one tax-free and protected while you leverage it, you're now in control, you're the bank. So that's the short answer. Can you have two loans out at once on your policy, Justin said? Of course, yes. If your cash value is 10 grand, you could take out $5,000 today and $5,000 out tomorrow. You could take out $2,000 today, $2,000 tomorrow, 2,000, 2,000, 2,000. You could take one 10 grand lump sum. And then if you repay your policy $500 a month, and after 2 months it's at $1,000, you can take $1,000 out again and do something else with it. So you use your cash value like a line of credit, like I mentioned. That's how your loans pretty much operate. If you have life insurance already, Diane, you can switch it into a whole life. If it's just term insurance, then there's nothing to switch it over to or convert it into. Term is just there's no value you have with term. So you're not getting anything with term. But if it's a IUL, VUL, or something like that, yes, you can convert it over. All right, let's get Angie to your IUL question. I love this question. I talked to an IUL agent yesterday for an hour, and we pretty much argued for an hour on why these strategies make sense or less sense for IUL versus whole life. It was a interesting conversation. So you have 3 IUL policies. You can only get a loan up to 90% of the cash value. What percentage does whole life insurance allow as a loan from cash value or death benefit? You then said, if I have a lump sum pension that I'm deciding to put in either whole life or IUL, what's the difference from IUL or whole life? All right. So IUL and whole life are not the same product. A whole life policy with a mutual company means that you pay your premiums to the insurance company, and that's guaranteed in the contract to earn interest and compound forever. There's no cost or fees in terms of administration fees or additional cost for managing the money. And the loan rates are fixed on your policies. The growth has a guaranteed growth that's fixed. The cost of insurance is fixed and set for life. It's completely predictable, completely stable. Whole life insurance has been around for 180 years. They've always made money in them. They've never lost money. And it's the most profitable thing that you can hold on your balance. Not most profitable, most consistent thing that you will ever have. And IUL was developed about 20 years ago, 25 years ago. It's a product where it's renewable term insurance. So every single year, the cost of insurance rises because you're getting older and less insurable. So every year, your cost will rise your entire life. And then the way they balance that out is they use most of your money to go do stock options, to invest in stock options and bonds in the market. And they usually give you a floor and a cap, a 0% floor and a 10% cap. There's also a participation rate. They will let you participate in 100% of the growth of your whatever you invest in. They'll let you participate in more or less. So there's a cap rate, there's a floor, and there's a participation rate. And the cost of insurance always rises. The insurance company is in complete control of the product. If they want to lower your cap rates, they can. They want to change your participation rates, they can. They want to increase your cost of insurance, they can. Nothing is predictable, nothing's guaranteed. It's going to change every single year of your life. There's no stability. The only reason, the reason IULs I think make sense is more for a comparison to a 401k. It's going to have the upside of the market, so you can have higher growth into it. But remember, we are not using a policy to get a high return. We're using a policy to control our finances and to finance things more efficiently. So it's a different concept. We don't use IULs because what if the market does bad? You have a 0% floor, but you still have cost of insurance. So your account loses value that year. And then you take a loan against it to go buy yourself a car. Now you have loss in value because the cost of insurance. You have a loan interest you have to pay. And if you have a maximum loan on your policy, you might lapse your policy and lose the policy because the cost might have eaten out any leftover cash value. You lose the whole thing. The possibility to lapse a policy is extremely high in an IUL, and there's no predictability in terms of loaning against to finance things you need. So if you wanted to put it into the IUL and put it there every single year of your life, never ever touch it, and use it as an investment, which is what it is. It is an investment because there's risk and it can go down, then that's fine. It's just a totally different idea. It's a product you're buying with a return, whereas whole life is a guaranteed product for banking and for stability and diversification. So it's a different idea. I spent 10 minutes on this question, sorry, but I hope that makes sense. Angie, let me know if that makes sense or not, or if you have rebuttals to that or concerns with that, we can talk about it. So if you have 3 IULs, please send them to me. Text me your email and send me the illustrations of them. Some IULs are actually designed well. Some are very, very, very bad. So I would be careful with it. I'd be careful to put more money into it. I'd be careful to get more with whoever set it up until you know if it's good or bad. I don't know how familiar you are with that industry, but maybe you just send them over to us and we can have our team take a look at it and tell you what we think. But go ahead and do that if you'd like. Justin, I know you've been blowing up the comments with your questions. I appreciate your patience on here. Anthony, thanks for answering some of these. Agreed, Anthony. I think IULs have a place in the world. I just hate when people sell it saying it's life and it's for banking. People will literally do the same presentation I just did and say, oh, but do an IUL instead. It's like, well, no, it's completely different morals, strategies, design. It's a completely different concept than using a whole life for banking. And they're saying, oh, banks own IULs. Oh, Rockefeller did his thing with IULs. No, they weren't even around back then. It's impossible. It wasn't a thing. So you can't say that. And then when you look at illustration from the insurance companies, they put 7% every single year. It's like, well, maybe that's what the average was, but that doesn't mean that's what's going to happen because that's not taking into account what if the market is 0 and your account loses value. They're just showing a steady compounding interest return, which is not compounding interest in IULs. It's simple interest because every year it readjusts and regrows, or it readjusts and grows based off the new value. So it's simple interest. It's not compounding. And so, I don't know, I just get kind of fed up with it because it's annoying how people talk about it and they sell it as if it's, infinite banking, but it's not. So anyway, guys, I'll wrap up here too. Justin, thanks for your questions. Thanks for everybody joining. If you do have more questions, again, shoot me a text. If you want to set up time to meet, please do. My email is carson@chrisnaugle.com. And my link to meet with me is carson.beyourownbanker.com. Appreciate you guys. Talk to you soon.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.